Okay, great. We've got a good number of folks that have joined us already, so I think I'll just go ahead and get started. My name is Sarah Schwid. I am the Trading and Real Estate Associate at Community Vision, and I'm going to just do a brief introduction, and then we will get started with the rest of the presentation. So today's webinar is, let me go to the title slide, Financial Management 101, Financial Concepts and Cash Indicators for Short-Term Planning. And we're presenting today's webinar in partnership with the Low Income Investment Fund. And our presenters today from Community Vision are Shama Kanakur, who's the Financial Management Consultant at Community Vision, and Ernesto Vilchis, who is a real estate consultant. We're also joined by Liz Winograd, who's the Senior Program Officer at the Low Income Investment Fund, and she'll give a brief introduction to give you a better sense about what LIF is and what the program specifically does, the child care program that she's the officer for. And as we begin our presentation, I'd like to start by acknowledging the original stewards of the land that we live and work on. I'm broadcasting from Huichin, which is the traditional, ancestral, occupied, and unceded territory of the Lishan Ohlone people. We recognize that as we work towards racial and economic justice, we simultaneously benefit from the use and occupation of their land. We also recognize the work that Indigenous communities are doing today to reclaim, rematriate, and preserve their land and culture. Just a couple of housekeeping items. We're recording this webinar and we're going to send out the recording along with the slide deck and any additional resources that we mentioned during the presentation. We're going to email it out to folks following the webinar. Once you exit, there's also going to be a survey that pops up, and we would really appreciate if you could just take a minute or two to complete that. It really helps us let us know how we're doing and just different ways that we can improve. And then please feel free to type your questions into the chat or the Q&A box at any time during the presentation. We're going to do our best to answer them throughout and keep an eye on things, but we also have a couple of moments during the presentation dedicated to Q&A. And it looks like we may have lost Liz. So what I think I'm going to do is maybe, Ernesto, you can go ahead and walk us through the agenda until Liz comes back and do maybe an intro of Community Vision.
Sure, I'll be good. Oh, there she is.
Okay, she's back. Hi, Liz.
Hi, sorry. Technology.
Yeah, no problem.
Nothing new in the last 2 years.
Right? It's just
Yeah, great.
for the course.
Sorry about that. Thanks, Sarah.
You're welcome. Yeah, feel free to go ahead and get started.
Okay, great.
Yeah.
Welcome, everybody. We're excited to have our partners, Community Vision, present to you this webinar this morning, the nonprofit management. Next slide, please. I'd like to tell you, my name is Elizabeth Winograd. I'm the Senior Program Officer for our Child Care Facilities Fund at the Low Income Investment Fund. Just a quick overview about who we are and what we do. Our mission and vision is everyone in the United States should benefit from living in a community of opportunity, equity, and well-being. We mobilize capital and partners to achieve the vision for people and communities. So over the next several years, LIF will focus on the way it works to play a leadership role in tackling systemic racial injustice. Next slide, please. So LIF is a nonprofit community development financial institution, a CDFI, and we mobilize capital as well as partners to achieve opportunity, equity, and well-being for people and communities. So LIF offers a wide range of products, including community capital loans, new market tax credits, grants, and technical assistance. So specifically within our ECE, our Early Childhood Education Division, LIF's core work in this area spans capital and structuring and development. We also provide technical assistance and policy and advocacy with focusing on developing quality early childhood facilities. We also have a strong track record of raising capital to support this work, including just this last couple of years, we deployed $28 million towards COVID relief for our early education providers well, actually not just in San Francisco, but across the state. Next slide. So here are some of the services that we provide. We provide one-on-one technical assistance. So we typically assign, if it's not something within our purview, we have our partners such as Community Vision, and a lot of the work that they provide consulting for is financial, real estate readiness, and then we also have technical assistance related to facility design and development. LIF also provides loans. We work in conjunction with our loan department and our loan officers to provide construction and new development loans. And then we also provide workshops, and some of the workshops that we provide are like today, finance. We also do human resources and employment law, helping to market your business, real estate, and connecting children with nature, and working towards a more natural and outdoor environment for childcare providers. And then we also provide grants. We provide grants for family childcare, business and child development centers. These grants are to preserve and increase the supply of our high quality licensed programs in San Francisco. So for family childcare, we provide renovation and repair grants. These are grants that we provide up to $15,000. We also provide startup grants for family childcare providers. For our centers, we have renovation and repair grants up to $200,000. And then getting into our capital and new development grants. So we do pre-development as well as, which is supporting planning and development of viable new childcare centers. And then our capital and new development grants, which is for also planning as well as the construction and development for childcare centers in San Francisco. And then some grants to help start up the initial cost to opening up. And typically this is based on the number of children that are at the center. So just a little bit about us. Thank you for joining us. And we hope this is a really helpful webinar. I know it is. And I'm going to turn it back over to Ernesto. Thank you.
Good morning, everybody. I hear my son outside wanting to say bye, so he might storm in right as I'm about to get started. And Liz, thank you so much. My family actually benefits from some of your programs because you helped to build. Can you all hear me? My screen seems to be frozen. Yeah. The playground at our childcare was funded partially by a LIFT grant, I believe. So thank you.
That's great. Yeah. Wonderful to hear. Thank you.
It's great. And they enjoy it a lot, and we enjoy it a lot. So today, so first of all, let me introduce myself real quick and give Shama an opportunity to introduce herself. My name is Ernesto Vilches. I am a nonprofit real estate consultant with Community Vision. And I'll tell you a little bit more what that means, what my role is. I have been with Community Vision for about 3 years now. And I can tell you it's the best job I've ever had, partly because of the work that the organization does. I'm always very excited to come to work and work with organizations like all of you who are attending today. And I'll pass it to Shama before I go on. Shama, you want to quickly say hello to people and tell them about yourself?
Sure. So I'm Shama. Good morning, everyone. And I'm a financial management consultant with Community Vision. And it's exactly 1 year now since I started working here. So it's my 1-year anniversary. Super excited, super kicked about working here. And as a financial management consultant, I support all our clients with everything related to finances. So, charting out the different scenarios for them for revenues and for expenses, budgeting, cash flow projections. Some of that you'll see that today. Supporting them through their grant application. So basically anything and everything related to money. So with that, I'll pass it back to Ernesto, who will take us through the rest of the agenda and start the first section of this webinar.
Thanks so much. Yeah, so we'll start. Today we're going to do a financial concepts overview. We're really going to walk you through, key financial statements, what they mean, what they're used for, why they matter. We're going to be then pausing for brief questions, but also one thing that I want to invite you to do is, as we're presenting, if there's anything that, pops into your head, put it into the chat box, and we'll either do our best to try to answer them there. And for anything that requires a larger discussion, we're going to pause after we do this preliminary financial concepts overview. We're going to pause and address some of those bigger questions. But you don't have to. You shouldn't feel like you have to wait until the questions section. Just type your questions on the chat box, and we'll try to queue them up for the questions portion of the presentation. So after that, Shama will we'll go into more detail about cash indicators for short-term planning, and that's where it really gets more into the very detailed numbers and how to calculate things that will help the organization to better plan for the financial management of the organization. And then at the end, we'll do the same thing. We'll pause for some of those questions that we're not able to answer during through the chat box. We'll have a bigger discussion, and hopefully we'll be able to, at that point, for some of the bigger questions, give you a time, pass the mic over to you if we can work that out, so you can ask the questions live instead of just on the chat box. So that is the agenda for today. If we can go to the next slide, Sarah. So we told you a little bit about ourselves. And I know that you put in the chat box, a lot of you have put in a little bit about yourselves. For anyone who hasn't had a chance, I invite you to please, tell us a little bit about yourself, your name, your organization, your role within the organization, if you feel like sharing that. I'm quickly looking through the chat box, and I see a lot of organizations that we're familiar with, Little Manila, hey there, Cutting Bowl Theater, and etc. It's great to see you all here, and I'm hoping that the material that we present today will be really helpful for your organization. So welcome, everybody. All right, so let me tell you a little bit about Community Vision. So we are what is known as a CDFI, a Community Development Finance Institution. That basically means we're a lender. We're a lending organization. That's the roots of the organization. But we're not like every other lender or like most big commercial lenders that you often think about. We're actually very centered on promoting economic justice and alleviating poverty by increasing access to financial resources and really giving access to communities that have been underserved by the financial sector. And we do this primarily through four different venues. We, of course, we provide lending, which is, again, the roots of our organization. And we do what is called New Market Tax Credits, which is a federal program that enables organizations to acquire and renovate property and stabilize their organization. We provide consulting and New Market Tax Credits. We are also a socially responsible investment platform. So for individuals that are looking for an opportunity to invest their money into socially responsible opportunities, we are that vehicle. We also try to influence policy. As I mentioned, the core of our organization or our mission is to try to increase access to resources for communities that haven't been served in the past, primarily BIPOC organizations. And so we try to influence policy to enable us to do that work better. There's a lot of regulations that prevent financial organizations from properly serving those that need it the most. And so we try to eliminate barriers in the policy world, both at the local, state, and federal level. And then the fourth category that the services that we provide is consulting services. And this is where Shama, Sarah, and I are based within the organization. So we work with nonprofits. Actually, Sarah, if we can go to the next slide real quick. So here's a brief overview of the services that we provide within consulting. So Shama is our expert on financial management, and I provide more of real estate-based consulting services. So on my side, I help organizations we help them to navigate the real estate process. So for organizations that are looking to lease space, acquire space, renovate space, we can help you to figure out that process. Typically, nonprofits are great at delivering services, but they don't have someone in-house to navigate that very complex and specialized aspect of running an organization, the real estate part. And so we come in and we provide, financial assessment and education. We provide, modeling for the organization for how their business model is structured. Shama, she already mentioned she's on the financial management side, and so she also helps with more of the strategic planning related to financial management of the organization. And then we also do some, like education workshops, and this is where Sarah really shines. She helps us to coordinate all these workshops and like the sharing some of the knowledge that we have within the organization. Lastly, I will say, if anyone is interested in accessing some of our resources, the easiest way to tap into our sphere is by scheduling a call with one of our consultants. And you can do this by going through our website, communityvisionca.org. And in there, you can sign up for a rapid response technical assistance. So you can get up to 45 minutes with a consultant to talk about your real estate or financial management issues that you might be facing. And then we can point you into different resources that we have, or we can give you some ideas on how to tackle those things. Okay, so that's about us. That's about Community Vision. Probably took longer than I should, but I really wanted to let you know about what we do, so that if we can help you in any other way, you can come to us if we can help you. Sarah, if we can go to the next slide, please. That'd be great. All right, so I'm going to start with the bulk of the presentation, which is going over the financial concepts. It's just an overview. I'm going to talk about what the different accounting methods that are typically used, and then we're going to talk about what does it take to assess the financial strength of an organization, and to have a proper financial system in place for the organization. And that typically involves two things. One is analyzing the past, like how the organization is performing, but also looking at the future as to like where you're going. And that's like really, those are two parts that really make the financial structure really one solid thing, right? And then we're going to talk about financial capacity and how do you measure that, like through index, through different metrics that you will use to measure the financial capacity of the organization. So that is what I'm going to be starting with. So Sarah, if we can go to the next slide. Thank you. All right, so just all take a deep breath. We're going to be talking about a lot of technical stuff. Again, I invite you to please put your questions as they come up on the chat box, so that we can monitor like where things are we need to clarify. Also, if you think you want me to pause on one of the slides and get into more detail, just let me know in the chat box. All right. So the two most common accounting methods, we have cash accounting and accrual accounting. And cash accounting basically just tracks the flow of cash as it comes into the organization. So, when cash comes in, you put it into your books, and when cash goes out, you also record that into your books. It just basically tracks the activities that the organization is doing, mostly just related to cash, to how cash is coming in and out. The other one is accrual accounting, and that is more when revenue is recorded when it's earned rather than when cash comes in. And I'm going to give you an example of that difference, right? And it's the same thing with expenses. You record expenses not when you pay for them, but when you actually incur the expenses. So with cash accounting, the organization simply reports revenue in the period in which it received cash and deducts expenses in the period in which they're paid. And with accrual basis accounting, the organization reports revenue in the period it earned and expenses when they are not incurred. Typically, cash accounting, it's easier, and that's the method that is preferred by smaller organizations because it's just easy to monitor, to track. However, most medium and large organizations use accrual accounting. And accrual is preferred for larger organizations because it really improves the financial picture. It allows you to see where revenue is coming from and where expenses are going. It matches revenues with expenses. And then also it's the method that is required by GAAP, which is the generally accepted accounting practices. This is kind of like the accounting practice that when you do your audited financials or big corporations, the GAAP are the rules that kind of everybody plays by. And so that is one reason to also use the accrual. In general, the accrual method improves accuracy, and it just really allows you to better match, not just the cash flow, but really tying it to the activities of the organization. So it just matches how the money that is coming in really matches with what you're actually doing on the ground. So let me quickly give you an example. If we can go to the next slide, Sarah. Great. All right, so here I'm going to walk through two brief examples of the difference between the two. So on columns, so year 1 and 2 under cash. So we have on the first example, let's say that you receive $1,000 revenue for workshops that you're going to be delivering over a 2-year period, right? In the cash accounting example, in year 1, you would record the full $1,000 as an increase in your cash account. So in your balance sheet, you would record full $1,000 as revenue. And then in you would record the $1,000 increase as cash in your balance, and also a 1,000 increase in revenue in your income statement, right? All activities happening in year 1. However, as I mentioned, this is for a 2-year program, right? And you're going to be, let's assume that you're doing the first part of the program in year 1 and the first part in the second part in year 2. Under accrual accounting, you actually recorded over 2 periods. And I just noticed that for some reason in our year 2 box here, it's showing a blank, should be showing some numbers there. But basically under accrual, let's say that you're going to be delivering the first part of the services in year 1, the second part in year 2. So you would record 500 increase in revenue in year 1 and 500 increase in deferred revenue liability. So you would break it down. So you recognize the first 500 that you received this year, and then you say, we're also going to receive 500 in the future, but we cannot fully recognize it. So let's record it as deferred revenue. And then you in your balance sheet, you also put the increase in cash in year 1. In year 2, and again, I apologize, and I don't know what happened to the numbers over there. In year 2, you would show an increase in revenue of $500 there. Cash, you wouldn't record anything there. And then you would decrease the fair revenue in year 2 by $500. And so basically it smooths it out over 2 years. So again, that more closely matches the financial numbers with how the activities are delivered. And the cash example that I just showed you here, everything is recorded in year 1, even though you actually have activities that will be associated with that fund that doesn't happen until year 2, right? And so the accrual is a better reflection of how the actual activities are taking place. And so that's one of the reasons why this is preferred. It's a better picture of what actually is going on in the organization, both from a financial perspective and your program delivery perspective. The second example that we have here is, let's say that you receive, you're in year 1, and you receive a bill for $600 in May of this year, right? But you decide you're not going to pay it until next year. So, even though you got the invoice today for whatever services were provided to you, you don't do anything in year 1 under the cash scenario, right? The cash system. In year 2, on the other hand, you record both the expense associated with it in your income statement, and then the $600 decrease in cash when the cash goes out, right? And so again, you see, even though the activity is really happening in year 1, nothing gets reflected there. By comparison, in the accrual scenario, that same activity, you would record it as follows. So the moment you receive the invoice, you record it as an increase in accounts payable in your balance sheet, right? And you also, in your income statement, you record it as an increase in expenses, right? So you immediately recognize it because it happened this year, right? However, even if you only pay it next year, what you do is you record the $600 decrease in cash when the cash does go out, and you decrease by $600 the accounts payable that was recorded in year 1. So basically, in year 1, you increase your accounts payable by $600. In year 2, you bring it down by $600. So again, I hope that this illustrates how the accrual system is a better reflection of like when activities are taking place. And so that's one of the reasons why it is preferred by a preferred method of tracking your accounting. Let me quickly, so the impact on the income statement, I think this is also something that is really interesting. So the income statement down below, the recording under the cash accounting, you have, in year 1, their income statement, you have positive net surplus of 1,000. In year 2, you have negative net income of 600. Whereas with the accrual system, your net income is a little more stable. So with the cash, you have more fluctuations. And so, it's not as reflective of what is actually really going on in the organization. And the balance sheet, there's not as much difference in the two, but there is a difference in how the individual composition of the different elements of the balance sheet. And I'll talk more about both of those income statements, the balance sheet, about those financial statements, the income statement, and the balance sheet to address some of those points. All right, so I hope that this illustrates the difference between the two. If anyone has any questions or wants me to pause, please do let me know. I'm not able to monitor the chat box, but someone can just, maybe Shama or Sarah can let me know if someone wants me to pause there. If not, we can move on to the next slide, in which we get into more detail about key financial statements. So, as I mentioned, having a good, solid financial system in place requires 2 things. One is looking, how the organization has been doing, where it is today, and then the other one is looking at the future. So let's start with looking at the past, right? Why is that important? So there are a couple of things that looking at the past really enable, a few things that it enables you to do. One is, of course, having a really solid understanding of the financial position of the organization. So knowing where are you today, right? Like how's the organization in terms of like their assets, their liabilities, all that kind of stuff. It also helps you to look at how the organization has been doing over a period of time. So looking back, how did we do in the last year? How does that compare with the year before and the year before? And you start to see trends, and you start to see is the organization in general moving in the right direction or not. It also, looking back, it allows you to look at how cash is coming in and out of the organization. There's a little bit of when you move to a more robust accounting system and you start to move to accrual system, you still have to track how cash is going in and out, and you have to do a little bit of reconciliation between the actual flow of money and your more accrual-based financial statements. And so that is an essential point of analysis, because that will raise some flags of potentially maybe your systems not fully capturing stuff, or more basic structural issues about the organization and how the organization is run from a financial perspective. And then the other reason why we also want to look at the past is you're simply required to. You have to file, you have to do legal filings, you have to file 990s with the IRS. You also have to, even if you don't have to file it with, beyond filing your 990s, if you're approaching funders, donors, or getting a loan or something like that, they want to make sure that you have appropriate recording of everything that has been going on in the organization, so that they can glance at that and really have an understanding of how their organization is doing, and whether investing into this organizations have what it takes to deliver the programs they're promising, and so on. So those are some of the reasons why analyzing the past is important. And so the way we do this is primarily through a few financial statements. The two most popular ones are the income statement and the balance sheet. So I'll go briefly through those. So Sarah, if we can go to the next slide. All right. So understanding your financial position, right? So like, where is the organization at any point in time? That is the statement that we use to analyze the financial position of an organization is the balance sheet. It really gives you a snapshot of the financial health at a single point in time. So when you look at a balance sheet, it usually has a date that it's reflected. So usually it's the date when your fiscal year ends. For some organizations, it might be June 30th, or for other ones, maybe December 31st, or they might have some other date that they pick that better reflects how they operate. But it's just, when you look at a balance statement, it's one point in time. How is the organization doing on that day, right? And so what this organization does is, what this financial statement does is, it looks at the organization's assets and liabilities. And let me briefly explain those two. So an asset is a resource with economic value that an organization owns or controls, with the expectation that it will provide a future benefit. It's basically anything that you own. That can be, your bank account, money in your bank account. Maybe you have an endowment, you have some equity, some assets, some stocks that someone donated. Maybe you have a building, maybe you have cars that your staff drives around. All of those things are assets, because you take all of those things, you use them to basically generate some value for whoever your community is, right? Or whoever it is that you're serving. Liabilities is basically what you owe related to this. It's basically legal financial debts or obligations that arise during the course of business operations. And basically, yeah, so think about that as if you have a mortgage on a building, if you, for example, owe to a service provider some money for services they have provided, all of those things are your liabilities. And here we're providing a really simplified version of a balance sheet. And typically the structure, the way this is structured is, you start with your assets at the top, And the assets are listed in order of liquidity. You start at the top with what is known as your current assets. Current assets are things that you can convert into cash within 12 months. So, if you have a bank account, that's already in cash, so you start typically at the top. If you have grants received, like if you have money coming in from a grant, but promises for that money to come in, that would also, if that's coming in within the next 12 months, would be recorded there as well. And so as you move down this list of assets, the farther down the list you go, the less liquid they are. So you cannot convert them as easily. So after current assets, you have fixed assets. These are assets that take longer than 12 months to convert into cash. And those things are things like building improvements if you own, your property, taxes, cars, for example, might fall into there. FF&E, furniture, fixture, and equipment falls into that. And so all of these are your list of assets, right? You list all of the things that the organization has under control, and you put them there. Then come your liabilities. So liabilities are equally split. They're listed from the ones that are coming due within the next 12 months. Those are your current liabilities. And then below that, you have your long-term liabilities. So again, liabilities that are coming due farther than 12 months out. And the reason why you do this, Shama will get into it, because you can look at some really important liquidity metrics for the organization. And so this is why the assets are not just simply listed, assets and liabilities are not just simply listed without regard for when they're due or when they're available for your use, right? So again, for the balance sheet position, the bottom line is basically you take your assets, you subtract your liabilities, and what you have left over is your net assets. So that's for nonprofits. Like a comparison to like a for-profit business, for example, the net assets, it's the equity of the organization. And what this net assets represent is the accumulation of operating surpluses or deficits since the organization was funded. And basically that is a metric of like the health of the organization. And net assets actually can break down into two types of assets. So if we can briefly look to the next slide, Sarah. Actually, this one also, for some reason, is the terminology has changed actually. So the what is labeled here as unrestricted is now, the accounting rules change, and now that is known as net assets without donor restrictions. Previously it was referred as unrestricted net assets, but basically what it means, as the name says, net assets without donor restrictions, is exactly that. It's assets that basically you can just use for whatever it is you want. They're not earmarked for anything. You can just basically, if you want to use it for overhead, you go ahead and use it for that. And then you have other types of assets which do have donor restriction. That's the other category that what we have here labeled as restricted assets, net assets. It's actually now known as net assets with donor restrictions, right? And this basically, as the name says, is actually very descriptive, is if a donor has given you some money to spend on programming that is very specific type of program, it's earmarked for that, right? Or let's say that a donor has, you're planning to buy a building and someone gives you, $1 million specifically for the purchase of the building, those assets are labeled as net assets with donor restrictions. So you cannot use it for anything. From an organizational perspective, net assets without donor restrictions are more desirable because they give you more flexibility to use them as you see best, as it best suits the organization. So that is just a brief overview of the balance sheet. I'm going to quickly pause because I've been seeing little boxes pop in. Shama, is there anything that we need to answer at this point?
There have been a lot of questions, but I've kind of typed the answers to those. So I think there are quite a few questions that We'll take a bit of time to go through, but I think they've been answered, so you can continue.
All right, Sarah, if we can go to the next slide. Okay, so the income statement is probably one of the financial statements that most people are familiar with. And basically in this financial statement, you record what you earn, that's your income, what your organization is bringing in. And then you remove expenses, what you're spending on any one period of year. And this one differs from the balance sheet. The balance sheet, as I mentioned, is a one period, like a snapshot in one, like at a particular point in time. The income statement is actually over a period of time. So typically a year. An organization puts it together, looks at, how did last year go? What is your income? What is your expenses? This, by the way, is also known as the P&L, the profit and loss statement. And so it's relatively straightforward. You start with your income at the top, list all your sources of income that you expect for the year. Typically, this is done on an accrual basis, not on a cash basis. So if the government, if you're getting a grant for a pledge for 447, you record that in there as money coming in for this year, even if you haven't received the check, or you might be receiving it farther down. So then you also list your expenses below that. Down below, you have your net income. Basically, that means what's left, right? So if you were for profit business, that would be kind of like your profit. So I'm not going to spend a lot of time on this one. I think this one is the one that is most straightforward for most organizations, but feel free to add any questions here. What I do want to spend some time is just showing you what the connection is between those two statements, right? So if we can go to the next slide. All right, so here is how this statements connect. So on the left, you have the balance sheet. Again, that is for a point in time for the organization. And on the right-hand side, you have the income statement. And you can see in the income statement, you start with your total income of $980,000, and then you have your total expenses, and then you have your net income of approximately $21,000. So the way that connects is basically that's money that gets recorded in your balance sheet as your change in net assets. And that is the connection between the two organizations, the two statements, right? Again, the income statement is like how you did throughout the year, and then all of that money gets reflected into the balance sheet as how the organization is changing. Remember when I was talking about the balance sheet, I mentioned the net assets is an aggregation of how the organization has been doing since it was funded, right? And so this is what that illustrates this. On this particular year, they added to their net assets. If, for example, the income statement were showing a negative net income, that would be recorded as a negative change in net assets in the balance sheet, and your net assets would be lower than what you started the year with. So generally, when an organization is growing and net assets are growing on a yearly basis, that means they're accumulating positive net income over a number of years. So ideally, you want to see that, or at least have it be stable. You don't really want to see it declining over an extended period of time, because that would be an indication that the organization probably needs to rethink a little bit about how to structure their programs. So that's the link between the two statements. Both of those statements are recorded typically on an accrual basis. Again, going back to where we started, the accrual versus cash. But there is still a need by organizations to track how cash is coming in and out. And so this is what the next statement, where the next statement comes in. Sarah, if you can quickly go to the next slide. Here we go. So the statement of cash flows is basically, it's just a snapshot of how cash has been changing over time. This one is also a statement that is over a period of time. So income statement, again, it's over a period of time. Balance sheet is a particular point in time. So statement of cash flow, the purpose of the statement of cash flow is basically to present cash inflows and outflows for a reporting period. And the reason why this statement is necessary is that cash flows are not really apparent when you just review the income statement alone, especially if the income statement is on an accrual basis, right? And you always want to be tracking how your cash is coming in and out, because that is something that is really important. One really nice thing about the statement of cash flow is that it allows you to break down the flow of cash from your operating activities, from finance, so like what you do for your programming, for example. It also tracks cash from financing activities. So if you have if you've borrowed any money or you have repaid any money, it allows you to track that separately from your operating activities. And then last, you have the cash from investment activities, which is, if you have an endowment, for example, or you have like someone gave you stock and you have money coming in from that, that's, you can track that separately. And so it allows you to really get an understanding, not just of where you are with your cash, but like how it's coming from different activities. And this one is a little bit more, I wouldn't say complicated, but there's an example here. So you start with the information from the income statement, your total income and expenses. You adjust that net income for some cash or non-cash items that are recorded there in your income statement and your balance sheet. And you make adjustments to really figure out what, how the cash has been coming in and out. And, we'll have more examples down the road, but I think just to give you an idea of how this connects with the balance sheet and the income statement. If we can go to the next slide. All right, so here you can see a little bit better how the statement of cash flow connects with the other statements. You can see that the numbers are connected. So on the right-hand side, you have the cash flow statement, which really shows you how cash flow is flowing through the organization. In the end, you will have a better idea of like the ending cash on hand. And if you go to the left-hand side where the balance sheet is, you will see that the numbers match, right? So the ending cash on the cash flow statement is $6,843,000. On the balance sheet, that is reflected on, at the end of the year, how much cash and cash equivalents you have on hand. Also, on the way that the cash flow connects with the income statement is you start with the net income. If you go to the statement in the middle, which is the income statement, $21,000 approximately of net income. That's what you start with to track, how much money is coming in during the year, and the cash flow statement over on the right-hand side. And that $21,000 is also recorded in the balance sheet as the change in net assets. So basically, you're just reconciling all of these numbers. Again, the two statements on the left would be on an accrual basis. The statement on the right would be on a cash basis. And this gives you a full picture of the organization. The balance sheet tells you where you are today, gives you a good picture of like, the resources that the organization has. The income statement gives you an idea of like how you have been performing the last year. Or like whatever period you're looking at, and then the cash flow statement reconciles, how money's coming in and out throughout the organization. So that all of those three statements together give you an idea of like how the organization has been doing up to this point, right? And so that's kind of looking at the past. Now let's quickly look at projecting the future. So the reasons to project the future is you want to make sure that the organization is delivering on the vision and mission that it has stated, right? So making sure that the organization is delivering on those things, and forecasting into the future will help you to do that. It would also help you to figure out whether you're delivering on your program goals, whether you're meeting your financial goals. For example, you might be thinking, in 4 or 5 years, we want to buy a property. That means that we need to build our net assets so we can have something to put down as down payment, for example. And so you want to make sure that if you're working towards something like that, that you you have a way to get there, a roadmap to get there. And this is what the planning for the future enables you to do. The other thing is track the impact that you're having. You might have this mission and vision, your program goals, and you want to make sure that you're having the right impact. And so this is where forecasting into the future allows you to make sure that you're having the impact that you want to have. Okay, if we can go to the next line. Thank you. So for projecting into the future, the most basic and most essential tool that you have is having a budget for the organization for the year ahead. You can also have it for multiple years, and that would show a lot of foresight on your part, and it's really good for you to do that on a multi-year basis. So you can have budgets in different types of formats. You can have it on a quarterly basis, on a monthly basis. You can have it on a program basis, which is what we're showing here. Multi-year. You don't have to do all of those. Just pick the one that better suits the organization and run with it, right? Perfect it. Just figure out what gives you the information that you need to really understand where it is that you're going to go. This program, this budget that we're showing here, I actually really like it because it really allows the organization to understand how the effectiveness of their program, not necessarily effectiveness, but how programs are performing. Right. So, for example, it's broken down by the different types of programs: the administration costs, management and administration costs, the fundraising costs. This structure, for those that are familiar with 990s, this is what how it's reported in your 990 reports. But basically, this allows you to look at, for example, if we look at column B, program B, that program is operating at a deficit, right? Whereas programs A and C are operating at a surplus. And that doesn't mean that you should eliminate program B, like maybe program B is something that is core to your organization, right? And perhaps even more important, programs A and C. So you want to continue with that program, but maybe you want to make some adjustments, right? Maybe you can figure out, do we need to bring in more funding for that? Do we need to maybe lower some of the operating costs and so on? The other thing is, it allows you to look at fundraising. Is that really is a really good investment of our programs or not? Do we want to continue with that, or do we want to make refinements to this? So that is kind of like one of the core tools for looking forward. The other one is the quarterly variance report. Basically, you look at the budget that you have for the year, you break it down into quarters. In this particular case, if you look at the third column, the year-to-date budget, you have this your budget broken down for the quarter. You compare it to how you're actually performing, and then you look at, in the last column, the variance, right? Comparing where you are today, versus what you expect, where you expect it to be. And you look at those those differences, and you want to flag items that are really big, really, if you're within 10% of where you expected, you probably are okay. If it's larger than 10%, you might want to look at it and maybe make adjustments. So, for example, individual contributions, you're down by 19% on that first quarter. Do you want to do a bigger push so you are meeting that goal, right? For some items like repairs and maintenance envelope, you have an under investment. Is there a reason for that? Are you falling behind on keeping the whatever your space in good shape? So it's really just a tool to help you make adjustments as you go, right? And so this is why this quarterly variance report is really important. It's just an opportunity for you to course correct over a period of time, rather than getting to the end of the year and thinking oh wow, we didn't really do this, or we fell short on this goal. It's really more throughout the year, making the adjustments to make sure that you're getting to where you want to go. The budget cycle, it's really just, we always say that a healthy organization is always budgeting, and that's what that quarterly variance report is about, is always assessing how you're doing, developing projections, looking at the variances of where you are between your projections or where you actually are today, making adjustments. And so that's why it's really called budgeting process, the budget cycle, right? It's not, you don't do it just once every year, you do it throughout the year and you make adjustments and you're always refining. It's not a static tool, it's really just always moving and like navigating this process. And one other tool that I wanted to mention is the cash flow projection. So not just looking at, a year period, like beginning and end, but it's really looking on a monthly basis. And with this tool, you basically take your budget, and this one is done not on an accrual basis, but when actually cash is expected to come in. And this is really helpful for organizations that make this because especially if you have fluctuations in your programming during the low part of a seasonal program cycle, when you might not have income or delays in income, you really want to flag those periods to make sure that you don't run out of cash. Or if you're establishing a new program and revenues are uncertain, you also want to have this tool in hand to make sure you're not running into trouble. And the tool is basic, so you do it on a monthly basis. You start with the beginning cash on hand down at the bottom on July, 6,843. And then you compare the money that is coming in, the money that is going out, the ending cash. And we flag here in pink some of the areas where an organization might want to think about it looks like our ending cash is kind of getting low. Do we really need to rethink of how the programming is delivered, or do we need to go out and maybe push for some of these grants to come in earlier to help us navigate those periods? And this is again a tool just to help you think about the year ahead and think about those fluctuations in income and expenses to make sure that you don't run into trouble. Liquidity is a really big issue for nonprofits. How they interact real quick, past and future. The past are the financial statements are static. Once you do them, they reflect there. That's it. You're done. How you ended the year, that's how you ended the year. How you performed during that year is also already past, done. And the cash flow statement as well. Everything in the past, static. The future, the budget, the cash flow numbers that I just showed, those are more dynamic, and those are about really making adjustments on a constant basis, right? Because the future is not static. It's you can go in a million directions, and you want to make sure that you are going in the right direction by being dynamic about how you manage those two things. Quickly, if we go to the next slide, the balance sheet, income statement, I've already mentioned, are typically managed on an accrual basis, and the cash flow statement has to be on a cash basis. For the future, the tools to help you, manage the future, the budget is on an accrual basis, and the cash flow is on a cash basis. And again, the cash flow statement helps to reconcile some of those differences between accrual and cash. But that just gives you a little better idea of even if you're on an accrual basis, there may be some elements that are managed on a cash basis. All right. So this is my last slide for my section. Financial capacity really is about, projecting realistically into the future, monitoring variances, monitoring how you're doing compared to where you projected, making corrections about, if you see something where you're falling short, or maybe you're doing really well, great. But you always course correct. Our goal is to really achieve surpluses at the end of the year. As an organization, maybe you don't want to run surpluses, but if you're working towards something, if you want to have greater impact, if you want to build on, maybe buy a facility, build more, buy equipment to better serve your population, you need to achieve some surpluses, build net assets, and invest those into growth. And it's a circular thing. You're always moving from one to another, and that's how you build the financial capacity of the organization. So I'm going to pause there. Sorry, I couldn't monitor the chat box, but if I can just quickly, Shama, is there anything here?
Ernest, so there was a couple of questions on program-based budget, such as, how would you spread fixed costs across program areas, and simplest ways to do that, and whether it makes sense to distribute certain costs such as insurance, equally prorating it across all programs.
You want to take a stab at that?
Sure. So basically, when you want to kind of prorate expenses over different programs, the ideal way to do it is to see how much of those expenses pertain to those programs. So for example, if it's, say, rent, then how much of the space of your building you're using for providing a particular program, and you would prorate it accordingly. And if it's insurance, then if there's particular insurance on property that you're using for a particular program, then you would put it into that program at a higher level than to the other program areas. So there's no right way to do it. It's basically the reason you would create a program-based budget is to see if, how the programs are doing at the end of the fiscal year. Do you need to make any changes? Do you need to cut down expenses, or do you need to go and try and gain more revenues? And also, if there is a deficit in one program and a surplus in others, you'd know which is actually subsidizing the other. And that's why you would create a program-based budget. So is there any other question?
Chef Mayer says that seemed to mean a separate formula for each cost center for each program. That is correct.
Well, yeah, that's right. It all depends on what makes more sense for you. And especially if you're going out and asking for grants for a particular program, then you want to make sure that, you're capturing all the costs appropriately for that particular program. And that's, again, it comes down to, taking a deeper analysis about what do you think you are going to incur for that particular program, and how best you can recover those costs from the different grants and from different revenue streams. So if there's no other questions on this, I'm taking a quick time check since we're at 11 o'clock. Let's move to the next section, and we can come back to questions at the end. This section will focus on the cash and liquidity. These are the indicators that you would typically use for doing short-term planning. Next slide, please. So there are a number of tools that we have here at Community Vision that can be used to determine your cash and liquidity position, and that you can use for your forecasting and planning purposes. The first thing that we'll go over is our financial decision-making roadmap. And then we'll also look at a very simple guide to determining your financial ratios. And that's a really quick way of looking at where you are at a given point in time, and also what those ratios mean. And then Ernesto took you through a cash flow forecast, but we'll dive a little bit deeper into that, so that you can project your cash flows for a fiscal year, and then where exactly you would stand in terms of your cash position. Next slide, please. So this is a screenshot of the Nonprofit Resource Center that we have on our website. And all of the tools that we have here under these different categories are free, they're downloadable, and you can customize it based on your organization's financial information. And in addition to the tools that we'll be discussing today, there are other tools as well, such as, should you be buying space? Should you be leasing space? Are you ready for your real estate? So these pertain to your real estate needs. And these are very helpful if you want to go ahead and do a real estate project. So feel free to check it out at a later point in time. And I think Sarah can just put a link to the resource center over here. And as I mentioned, so we go to our Nonprofit Resource Center and we'll put in a search function for our financial decision-making roadmap. And we would then put in our details and download the tool. And the next slide, we'll go over the template. So as you can see, It's a template that summarizes all of the key tools that we help organizations complete. And we help them think through these when we are doing planning and consulting work with them. So it encourages folks to take a look at all of your current assets, your cash balances, and your current liabilities. And basically, based on the results of the calculations, it might lead you to make some operational changes, which could strengthen your organization's financial health. So the way the template is structured is that every blue box here with a purple dot is a downloadable resource. So when you get to that square and it's time for you to compute that ratio, you would click on it. It'll take you to the tool on our Nonprofit Resource Center, and you'll complete the task. And once you get the answer to that, then based on that, you would follow along on the green line or on the red line. So you do that through the process and till you come to the end of the template. So now let's say we've gone to our Nonprofit Resource Center, we have put in our details, and then we downloaded this template. So next slide, please. So now we'll start with charting out the financial decision roadmap for our organization. So we start at the orange box on the left side. It says start, so we start there. And the first step that we have is to calculate our days cash ratio. So again, you would click on it and it takes you back to our Nonprofit Resource Center. Next slide, please. Now here we want to calculate our days cash ratios. So you would choose the guide to financial resource ratios, and then the guide over here asks a few different ratios. So you provide a few inputs based on your income statement, on your balance sheet, and you get some outputs. And that gives you a good sense of your liquidity position. So let's go to the next slide. Okay, thank you. So Ernesto took you through some of the key financial statements. So we have our balance sheet, we have our income statement. And so this is the template. On the left-hand side, you'll see that we need to put in details of our balance sheet. And so again, wherever there's a yellow box, that's where you would input the numbers from your financial statements. And in the middle section you'll have the income statement data that you would put in. And really from the income statement, we just need two pieces of information. One is our annual operating expense, and the other one is the annual depreciation expense. So putting in the numbers will calculate the liquidity ratios in the bottom. And then against that, you'll also see a benchmark on the right-hand side. So once you get your numbers, you would compare your days cash ratio to a benchmark of 90, your cash ratio to a benchmark of 0.75, and your current ratio to a benchmark of 3. Next slide, please. So in the last slide, we saw that the organization's numbers are compared to benchmarks, and a little more on benchmarks. So these benchmarks are basically taken from traditional financial institutions, from lenders, and from people who basically analyze your financial statements and your performance, looking at it through a lens of risk and risk mitigation. But here, as Ernesto mentioned in the beginning, we at Community Vision are focused on working and partnering with communities who are on the margins of opportunity. So communities of color and low-income communities. And we know that many of the organizations over here who are operating in these spaces have been unbanked for a really long time and have been kept out of the traditional banking system. And so because of that, it's a possibility that the ratios that we calculate are not in line with the benchmarks. We have a number of clients whose days cash is way less than 90, but they've been around for a long time and they're doing incredible work in the community and have shown a lot of resilience. So in that case, we have the absolute numbers, which are the ratios, but there's also a social narrative which needs to be kept in perspective as well. So I just wanted to highlight that and bring it out through this presentation. So with that being said, let's go and calculate the ratios and the numbers. So we look at an organization's ability to meet their expenses. And so that speaks to the health of the income statement that Ernesto referred to earlier. So if there's a certain amount of expenses annually, and in our financial statement, the example was about $959,000. So when we look at those operating expenses, we want to see how is the organization able to meet this sort of expenses, and whether they're able to meet it or not. And that speaks to the health of the income statement. Now, against that, there is the organization's ability to meet the liabilities, which are shown on the balance sheet. So what are the resources that the organization has to meet all the claims that's existing on its balance sheet? So these are the two ways that we look at the financial health and assess risk of an organization. So as I mentioned earlier, these are tools that are used by lenders to think about the risk in making a loan to an organization. So again, they have benchmarks, and the lenders like to know whether the organization is able to pay back the interest or to repay the principal amount and so on. And so again, within these ratios, there's a huge range depending on how you calculate the numbers. So you get really different outcomes. So there's a very stringent way of calculating the ratios, and there's a more lenient way. And I'll take you through both of them through our examples. Next slide, please. So we look at the days cash first because that's where we start in our roadmap. So days cash basically looks at your ability to meet your annual operating expenses, which is again a measure of the health of your income statement. And as I mentioned, there's a stringent way of calculating it, and there's a more lenient way as well. And so for the most stringent way, you would actually take the cash, which in our sample organization was about $6,843, multiplied by 365 days in a year, and divided by your annual operating expenses. And what it actually means is that if you did not have any other cash coming in for the rest of the year, how much of your annual operating expenses would you be able to cover with the existing cash that you have? And then if you want to take a more lenient approach, you would add in your receivables to the cash. Perhaps there's a portion of the receivables that's coming in and that can be converted to cash in a fairly quick period of time. And also you could include your line of credit, which you can draw on in the case of emergency and so on. And then there's the most lenient way, where you would take your cash, you would add in your accounts receivable, your line of credit, but in the denominator, you would not take the depreciation expense, which is basically a non-cash item. And so that gives you a better outcome. So next slide, please. So again, after you go to a nonprofit resource center, you've downloaded the template and you open the file. The first worksheet basically contains some language on the ratios itself, what they mean and the formula for calculating it. And the second worksheet in the file has this template that we just spoke about a few slides earlier. So for the income statement, we've put in our annual operating expenses, we've put in our depreciation expense, and we've put in a cash amount of $6,843. And after putting in these three pieces of information, the template calculates our days cash ratio. So in this case, we have 2.6 days cash, which means that it can only pay operating expenses for 2.6 if there was no other cash coming in. And just in terms of the tool that we're introducing, the left side is your balance sheet, your middle has the income statement, and the liquidity ratios are calculated below, which is compared against the benchmark. So next slide, please. So that was the stringent way of calculating it. Now let's assume that this organization knows that it has like some really big checks coming in the mail, and so its accounts receivable is going to be converted into cash very soon. They also have a line of credit that they can draw on. And so we look at a different scenario wherein we include those numbers in our calculations and create a better number for ourselves. So let's go to the next slide, please. Okay, so this is magic here. Now the organization has 62.14 days of cash. is the same set of financial statements, but now what we did is we added back the accounts receivable of about $155,000. And looking at the operating expenses, we've reduced the depreciation expense of $7,500. Now, this is a lot closer to the benchmark. It's not 90, but it's not 2.6 either. And so there's a story behind both numbers, and both numbers are equally correct. But just thinking about, like, if I were the executive director of this organization and I'm presenting these numbers to the board, say, and then I present a 2.6 versus a 62.14, I would imagine that the reaction is very different. And, you know, the truth is somewhere out there, which is in the middle. I guess maybe you don't add back the entire 155,000 of accounts receivable. But the point of showing these two different ways of calculating it is that there's no right one way. And, you know, you have to pick what makes sense for your organization, what's comfortable for you, and what you would back up. Next slide, please. So now we've calculated our days cash, and we are moving along in the roadmap to the current ratio. But before we go there, I just wanted to point out that, you know, when we did our first calculation, we got 2.6 as our days cash. According to this roadmap, it says that if you have it less than 90 days, then you would go to the next step, which is to calculate your more lenient way. And so we did that. We added back our receivables, we added back our line of credit, and we came up with a 62.14 number. Now, even if it's not over 90, we think it's a lot more acceptable than 2.6. So we are going to continue and trudge along on the roadmap. And then we go and calculate the current ratio. Next slide, please. So the current and quick ratios basically talk about the balance sheet health and the organization's ability to meet the liabilities on their balance sheet. And again, here, there's a stringent version and there's a lenient version. So the most stringent version would just look at amount of cash you have and compare that to the current liabilities. And we call that as the quick ratio. And the benchmark for that is 0.75, or it means that 75% of your cash should cover, 75% of your liability should be covered by cash. And then on the more lenient side, we'd add back the receivables, the prepaid deposits, all of your current assets, and then compare that to your current liabilities. And we call that the current ratio. And the benchmark for that is 3, which means that your current assets should typically be 3 times that of your current liabilities. Next slide, please. So here we've populated the rest of the organization's balance sheet. We see all of the assets, the liabilities, you know, and now after putting in all the information, we now see that the current ratio is 0.66 compared to 3, and the quick ratio is 0.03 compared to 0.75. And even without going into much of the calculations, we can tell by looking at the balance sheet that with about $6,843, the organization is not going to go very far in paying off its current liabilities or in meeting its expenses. So next slide, please. So just sort of wrapping up the idea of reconciling the stringent versus the lenient method. So it's a balance of rigidity and risk. And, you know, if an organization really ends up at these two very different numbers, such as 2.6 and 62, it's worth having a conversation internally and talking a little bit more on, you know, what makes sense for your organization and how much of risk is involved. It could mean taking a look at your accounts receivable aging summary. And if you haven't heard from a majority of your accounts receivable or your debtors, then, you know, what are the choices that you have and what should be your next course of action? Next slide, please. And so now we go back to the roadmap and we're moving on from the current ratio to cash flow projections because this organization is clearly facing some very tough times with respect to their cash flow. And if we were consulting with them and they were our clients, we would recommend that they do a cash flow analysis immediately. So let's see how we go about doing that. Next slide, please. So looking at the cash flow projections, again, this was what Ernesto showed earlier as well. So we can see that they have some deficits here, and then the months of July and August is really bad for the organization. So they started off with their closing balance for last year. So that would be the opening balance for this year. And that's on the left-hand side at the bottom with says beginning cash. And then you map out your budget against the cash coming in versus cash going out. And with that, they see that there's a couple of challenging months ahead in July and August. Things get better November onwards, but they need to get to that point. And so what are the strategies that you would use to do that? And since July and August are typically red for them, we would actually suggest that they break down that by week, because that'll give a better picture of what cash is coming in and how much cash is going out. And then we can try and come up with a supplemental strategy to kind of bolster the cash position. So next slide, please. So let's see how the organization does when it breaks down the cash flows into weeks. So a week is a long time. You can go to a lender, get a loan, meet with board members, donors, and so on. And so after they put in the weekly projections, they got an extra week. It looks like they're okay for the first week of July, but again, it's the week of July 8th that they are having a deficit. So let's see what strategies they could possibly use to fix it. Next slide, please. So we'll see that the financial decision-making roadmap has some suggestions as well. So once you do your cash flow projections, if the cash flow is negative, then it actually takes you down the roadmap to provide some alternative strategies that you could use. So the first step along is to identify extra sources of capital. So grants, advances, a line of credit, board members who can donate if you approach them, and so on. So after you've done all of that, you've gotten all your avenues of capital, and if your cash flow is still negative, then you would go to the next step, which is try to advance your receivables and defer your payables. So what this means is that you would, look at your aging summary for your accounts receivable, and if the people who are there who have not paid up for a long time, you would call them and say, "Hey, can you pay up?" And you would do the exact opposite for people that you owe cash to, and take some time from them in deferring your payables. And if that's still negative, then it's time to move to the next step, which is basically expense reductions. To temporarily put off some repairs and maintenance or professional development and so on. And if all of that still leads to a negative cash at the end of the period, then you might need to make some operational changes, some permanent expense reductions. So next slide, please. So the blue squares over here represents all the expenses that have been cut, or you may have delayed them. So for example, if you were planning to spend $6,400 for supplies in July, we are now going to cut it, or we're going to reduce it. And we were going to spend about $1,500 in August for repairs, which will hold off on, and so on. So now we see that the week of July 29th is no longer negative. The week of August 12th is a positive. We are moving in the right direction, but we still need to make changes. So let's see what could happen in the next iteration of changes. Next slide, please. So now we're again taking the occupancy cost of $6,300. We won't get rid of it because landlord is not that generous, but we'll push it to a later period of time. So say instead of paying on the first, we could ask the landlord if he could pay it at a later time in the month. So now we have a healthier balance, end of first week of July, and moving in the right direction. So now with all these workings, if we approach a lender, we know what we need to ask for instead of just throwing out an arbitrary number saying that we need X amount of dollars. So approaching lenders with this sort of backup documentation puts the organization in a better place. So let's see what happens next. So now they've looked very closely at expenses. They have reduced whatever is possible. They have deferred what's possible, and also the timing. And so they've come to a decision that they need a line of credit in the week of July, and that they'd like an amount of $25,000. So in the world of line of credit, that's not too high. You could get it from a local lender, a credit union, community bank. And for a $1 million organization, it's not too big of an ask. And so with putting in those numbers and also planning for a payback of that amount in September, we see that the organization is in a better position. The red squares have kind of disappeared. And so let's move on to the next slide to figure out our strategy. So over here, we'll see how the story ends. So after doing all these cash flow projections, they were able to take a really strong narrative with backup documentation to a lender and say, hey, we need a total of about $60,000 over the next 7 weeks over that period, but we need only $25,000 in the week of July 8th, which we could pay back $25,000 in the month of September. And that additional cash infusion would help us go through. And this is the sort of strategy that you would put together, and you would take it to a lender, or you would take it to a donor or anybody else who has capital available. It shows that you put a great deal of thought in planning out your cash inflows. It matches to your budget, and you've kind of planned the repayment of that as well. And so next slide, please. And so one thing about being a nonprofit is that there's a lot of consensus building and lots of opportunities to bring people along your way of thinking. And there are a lot of decision makers. So depending on how big your organization is and who's on your board, how many staff you have, how you engage with your constituents, you might have to share your strategy with them to get on board. Sometimes the board members are not very comfortable with asking for a line of credit. Maybe debt is something that they've never taken on. But with showing this workings, showing that, this will help you bump through a rough period of time, but you have a plan for repayment, and that's a good thing for the organization. You'll be able to meet your mission and build on your midterm sustainability and long-term sustainability with all these workings. This sort of helps you bring that consensus within your organization and to your board as well. So I will wrap up this section over here with just closing the fact that, cash and liquidity indicators are typically used for short-term planning purposes. And there's also a midterm planning where you would look at revenue sources and expenses and so on. And we have a webinar coming up for that in February. And the details of that are at the end of the slide deck. And with that, I know we have just a minute, so I haven't been able to see the chat, but if there's any burning questions, you can always reach out to us if we are not able to answer it today. But if anybody wants to ask for a question in the last 1 minute, please feel free to go for it.
Shama, there was a question about, actually not about the ratios. You great job on that. But one is, how often should budgets be revised within a fiscal year, and in what basis? And my response was, at minimum, I think it should be a mid-year adjustment, but doing quarterly variances is highly recommended. Would you concur with that? And also, I think it should be on an accrual basis, but then you should still do the cash flow on a cash basis. So that would be my answer.
Sure. I would just like to add on that is that typically when you do your budget, and as a nonprofit, you'll get it approved by the board. And once the board approves the budget, ideally the budget would not be changed through the year unless and until there is like extenuating circumstances that your existing budget does not make sense at all. And so the reason is that, when you create your budget, you put in a lot of thought and effort in it. And the way you would track your budget, whether you're on, is through variance analysis. And so doing that will help you ensure that, you figure out if you're over budget, under budget, and what sort of strategies you can take to get back on budget. But typically, once it's signed off by the board, it's locked and it shouldn't be changed until, like I mentioned, there's like crazy circumstances where an entire program line goes off track, or you want to add an entire source of revenues, which you did not even think of earlier, and so on. But variance analysis is a good way to keep in track for that.
Thank you. And sorry, I apologize for running out of time here, but here's some information about upcoming financial management series. You can sign up at communityvisionca.org. And Sarah, I don't know if there's anything else you want to say before we sign off.
Sorry, I couldn't hear you. Can you repeat that?
Yeah, I just was mentioning the upcoming financial management series, but is there anything else that you wanted to add? I just want to thank everybody for coming.
No, that's it.
Just
feel free to reach out and we will do our best to help you out, especially if you have more specific questions related to your organization. I think I saw one maybe that we missed that we didn't quite have time for, that was a little more specific. And also, yeah, just a reminder that we have our rapid response technical assistance program available. And I'll put the link in the chat right here, and I'll also send it out in an email following the presentation. But that's a free 45-minute call with one of our consultants to discuss what you're dealing with and have any questions that you might want to be answered. So, and Liz, if you had any closing remarks.
Yeah, no, thank you. I think this was a great presentation, and I hope everybody else thought so as well. And thank you, Kshama and Ernesto and Sarah. And I look forward to the next presentation.
Thank you all.
Thank you so
Bye.
much. All right, bye-bye.